Let's continue with the DCF schedule. So I will create another section here in my Excel file. I'll call it DCF schedule. We will need a few things from FactSet. So on the Overview tab, we can find WACC at 6.1%. You know, quite often we do our own calculation of WACC, and that's the right thing to do. But for this particular exercise, I'll kind of skip that step and we'll just take information from FactSet. I'll make it blue. Then another thing we'll need for terminal value calculation, I'll talk more about it. It's called the growth rate in perpetuity. I'll pick just 2.5%. This represents typical growth rate over a long period of time. And it's not really company specific, it's more kind of what the economy will grow at in the long run. So 2 to 3% is typically what people are using. And then for exit multiple, that's another methodology that we're using for terminal value. Let's pick 20 times here. It's a very high multiple, but we'll see that it's close to where Home Depot is trading anyway. So if we want to get values in line with where they're trading, you know, we should be kind of looking at their current multiple and also multiples for other companies, other transactions. I will format it as a multiple. So I'll go to Alt-TO and then number, custom, and then I'll pick it with X on the end. Valuation date. That's the value, that's the date when we're doing the valuation, obviously, but also it kind of impacts what cash flows we're taking and what discount rate we apply to them. I'll pick September 30th here as a valuation date. Let me now show you the formula for free cash flow. And I'll also set it up in Excel here. So we'll start with EBITDA, and then we'll have change in working capital. I'll call it WC. We'll subtract CapEx, taxes, and that will give us free cash flow that we will use for discounting. So we'll start with 12 months ending next January. So January 21st, we'll just find EBITDA in our model. Change in working capital will come from the cash flow statement. CapEx is also from cash flow statement. And tax, I have to be careful here. We're doing this on unlevered basis, meaning that tax shield shouldn't really be included in our cash flows. So for tax, what I'll have to do is calculate unlevered income before interest, income, or expense. And for us, it's really this EBIT line. You know, I can subtract this unusual expense, but it's 0. So that is my pre-tax income. And I'll apply the tax rate to that. So it's different tax for DCF purposes than we had on the income statement. So I'll apply tax rate to effectively EBIT, pre-tax income before interest expense. And I'll take it with negative sign. And then I'll add it up. And format it. I'll drag it to the right. So these are my free cash flows. The next thing I'll need to do is to find discounted values. But you know, in real life, some interesting issues that we're getting into would be and which cash flows to include. And I've drawn a diagram here just to show you when cash flows happen. So we typically use mid-year convention. That means that cash flows happen in the middle of the year. Now, they're definitely not happening at the end of the year. If you think about cash flow for the next 12 months, you don't need to wait to get them until the end of the year. They kind of happen evenly throughout the year, more or less. But then kind of the assumption, the best approximating assumption for when a specific time is, when the cash flow happens, is in the middle of the year. And you can see that on the timeline. So that'll impact what's the number of periods that we are using to discount cash flows. So you can see on this timeline that you know, I put in these dots in the middle. They're just kind of when we expect the cash flows to happen. And then the second concept that you need to be familiar with is partial period. So if our evaluation date is end of September, the way the company reports, they report earnings for 12 months ending January 21st. So in the near term, out of cash flow ending on January 20 of 21st year, you'll get four months of that cash flow. So you'll get October, November, December, and January. So we need to basically calculate the fraction of the year during which, you know, we will own the cash flow, and everything that was in the past should be excluded. This will belong to previous owners. Like, it's not going to be part of our valuation. So that's what I call year fraction. So basically, in Excel, the formula will be when the period ends. This will be January 31st, 2021, minus the valuation date. And Excel just takes, assigns a number to a date, so we can just take a difference in those two dates, and it'll give us the number of days in basically those 4 months. And then we'll divide it by 365, and that'll give us that partial year multiplier that we will use to adjust for this first year partial cash flow. And then every year after that, so the year and like the period ended January 2022, for that period we'll take full cash flow. So that's the year fraction adjustment that we'll have in Excel. For number of periods in discounting, what I'd like to do is basically calculate number of days from the valuation date until each of the dates when the cash flow is happening. So for the first period, it'll be actually half of our fractional year. So if we get 4 months of next cash flows, then we'll assume that they happen in the second month, in the middle of that four-month period. And then for cash flow 2, we will assume, we'll use the formula, we'll take the date of when that cash flow is expected to happen, which will be July 31st, 2021, subtract valuation date and divide by 365. And then for every year after that, we'll just basically take the next date when we expect the cash flow to happen. So let me put it in Excel. So my period is basically the number of periods by which which I use in discounting. So that will be January 21st minus valuation date divided by 365 divided by 2. Let me format it. I'll use 4 decimals here. I'd like to be quite precise in these calculations. And then after that, it will be January 2022 minus the valuation date. Now I'll freeze the valuation date divided by 365. And then if I drag it to the right, then I get basically another year every time. This is very similar to what you've seen in the textbooks. Like it would tell you, if you're 1 year out in your cash flows, then use 1 year in the discounting period. If you're 2 years out, use 2 for discounting. This is just a little bit more precise way of doing that, and it allows you to be flexible with the valuation date. Second thing, year fraction. So we'll take, when we expect the next period to end, January 2021 minus the valuation date divided by 365. And then after that is just full one, we'll have cash flows for full period after that. So the discount factor, and what that is the multiple that we apply to cash flows to discount them. So it'll be 1 divided by 1 plus discount rate to the power of the number of periods. I'll freeze the discount rate, and you'll see that it goes down with more and more periods. So from here, the DCF calculation is actually quite simple. So I'll call it discounted. I'll call them interim because they don't include terminal value that we'll talk about. Discounted interim cash flows. And it'll be the free cash flow times year fraction, the part of the year for which we will actually own the cash flows. So far, it doesn't have to do anything with discounting, right? Discounting is the discount factor. So we'll multiply by that as well. I'll format it and then extend it. So these are discounted interim cash flows. Now let's talk about the enterprise value. Big component of your overall enterprise value is terminal value. So it takes interim, sum of interim discounted cash flows and terminal value. So we'll use 2 methodologies for terminal value. I'll call one of them multiple of EBITDA. So here I'll just kind of use short multiple, but it's exit multiple of EBITDA. And the second one I will call GRIP. So terminal value is actually quite simple. It's multiple times EBITDA in the last year of forecast. I'll copy my formats. For growth rate and perpetuity methodology, we'll take cash flow before discounting multiplied by 1 plus the growth rate and perpetuity divided by discount rate minus growth rate and perpetuity. So growth rate and perpetuity gives us $455 billion. And again, it's the cash flow in the final year of the forecast times 1 plus the growth rate divided by discount rate minus the growth rate. And let's actually apply present values to these. Let's show all the numbers here in present values. So I'll multiply that future value of terminal value by the discount factor. So this is terminal value in present value terms. And then I'll say discounted interim cash flows. And I'll say sum of the discounted interim cash flows. And they'll be the same under both methodologies. Actually, all the numbers from here will be the same between the two methodologies. The only difference is the terminal value. So the sum of these two gives us the enterprise value. And to get to the share price, just to compare where would our valuation come out relative to the market share price, I would need to subtract net debt. That is on the balance sheet. I'll use the latest actual information. So I'll take short-term debt and long-term debt minus cash. I'll take it with a negative sign, just gonna for better presentation format. So we'll be subtracting net debt from enterprise value to get market capitalization or equity value. Market capitalization is based on the market share price. Here it's more equity value that we get from DCF. And then we'll divide it by shares outstanding. I guess we don't have them here yet. So let me pull them from fact set. So in millions, fully diluted shares outstanding. Let me take exact number. So share price would be the equity value divided by shares outstanding. So current share price look it up, is 269. So when I'm doing this analysis, obviously will change every day. And then recommendation I'll just kind of say it equals if share price is greater than, the share price that we calculated is greater than the market share price, then recommendation would be buy shares, right? Because you're getting more value than you get on the market in this valuation approach. Otherwise, we'll call it sell. Pretty kind of binomial here. So as you can see, the value we got from DCF is greater than current share price, so we'll buy under both valuation methodologies.
Now that we've calculated the share price implied by the DCF valuation, let me show you how to do a sensitivity analysis around it. The couple of metrics that are very important to DCF valuation, DCF valuation is very sensitive to, would be the discount rate, growth rate in perpetuity, and exit multiple. So these three variables that we've started with at the beginning of DCF work. So let me show you Excel tool that allows us to calculate share prices under different scenarios of these variables. The tool is called a data table, and it's different from any other Excel function in the sense that you don't type like equal and then function, like it doesn't work like that. It requires you to set up a sensitivity table, and it's important that you set it up right. Like if you put a number in a different place in the sensitivity table, it's not going to work. So as I do this, just keep an eye on kind of how I lay out things and where I put numbers, where I put formulas, and try to replicate it. I think it's a very powerful tool. Like for investment bankers, it's a big one. Like it's not actually considered advanced. It's like very standard. So I'd like you to know it and be able to use it. So let's set it up. So let's call the first sensitivity table exit multiple sensitivity. And then I'll have 5 cases for each variable. So we'll start with 20. And usually I put the base case, the one that we have in our price so far. I call it the base case. I'll copy format here so that I don't have to change it every time. Change the color here. Just for the headings, I'll make it all black so it looks better. And then let me do it 20 minus 1 going to the right, or 20 plus 1 going to the left. And what will happen is on the upper left, we will see, actually, let me do the other way. Let me have it increasing to the right and decreasing to the left. So in upper left, we will have the smallest value, and then as multiple goes up to the right, we'll have higher values. And for the discount rate, we'll also have 5 options. We will put the base case in the middle at 610. I'll do it like this here, just so that my formatting carries over. But then I'll kill these 2 because I will make them, so my discount rate will go higher. So it'll be 7% or 8% going up, or 5 and 4. I'll make it black just because it's a table for presentation purposes, not for modeling purposes. The important thing is these headings, they can have links and formulas. If you see, they can have links within the table, but you can't link these headings to outside. Now, on the other hand, in the upper left corner of this table, you want to link, not hard code, link a value that you would like to sensitize. So see how I've linked share price under the multiple methodology here. And this is the only case when I actually don't want to show this number, but I want to have a link. What I'll do, I'll make it white color so that people don't see it. So it's kind of, nobody sees it, but it's there, okay? And then the other thing I'll do here to center this so it looks like a proper heading, I'll go to, this is under format cells, I'll go to alignment and I'll pick under horizontal center cross selection, and under font I will make underline single accounting so it looks like a good heading here, and then I copied and pasted, and I'll create the column for WAC, just the heading for WAC. So basically in my row here I'm sensitizing exit multiple, and in my column I'm sensitizing WAC. So this is the most important thing. Again, it's important to set it up exactly like this. Now let me set up the second one as well, and then we'll actually populate it. So the second one, we'll call it grip. So far I just copied and pasted the first column. So obviously it's not exit multiples that we're sensitizing, it's growth rate in perpetuity. In the middle case, it's 2.5. Then let me go to 3. I'll just hard code it here, and then 3.5. And then on the low side, I'll say 2 and 1.5. And the WAC is actually good. Now, in the upper left corner, I will link share price to share price on the grip. That's what we'd like to sensitize. And let me maybe just one more thing before I actually show you the fun part. Let me format this table. So this is what I've highlighted just within these headings. That's where my values will be. Let me select number, currency. I'll have a $sign for the share price, but no decimals. And then I'll paste that for the second table. All right, so we've set it up. This is actually most of the work. It might look a little tedious, but again, important tool. Make sure you master it. So now what I'm doing, and again, it's important to do it exactly like this. So what you want to do, highlight, put a box where your headings are, right? You've highlighted it. And the way I highlight, I start with where my hidden formula is, and then I keep shift and move cursor to the left, to the right, and then to the down. So it highlighted this box. And now the shortcut is Alt-DT, stands for data table. Alt-DT, so this little window popped up, and it's asking me to input row, basically which variable do you want to sensitize in our rows? And that is exit multiple. And then in our column, we want to sensitize discount rate. So I press OK, and see what we have in the table here. So we have in the middle, under 20 times exit and 6.1 discount rate, we have 358, which is the share price, right? So let me maybe put a box around this one. And then as multiple goes up on exit, our share price goes up as well. So if you have higher exit multiple assumption, you get higher implied share price. For the discount rate, if the discount rate is higher, the share price goes down. And you can double check it. For example, what you can do, you can change this discount rate to 8 and your multiple to 18. So let's see, under 8 and 18, you get 294, which is exactly 294 now in our proper calculation. So basically what this data table did for us, it populated this table under different assumptions. It's very easy to do it second time as well. So same thing, highlight the table, press Alt-DT. For row input cell, select growth rate in perpetuity. Oops, I need to quickly Alt-DT for row growth rate in perpetuity, and then discount rate for column. And we've got 333 in the middle, the way we wanted, and goes up to the right, goes down to the top. Let me show you one more thing here. Let's select the values under which you would invest. Like what assumptions do you need to have so that you would make buy recommendation? And that can be accomplished with conditional formatting. So if you press Alt OD, Alt OD, create a new rule, and then I select format cells that contain cell value, let's say greater than 358, we'll format it as green. So basically whenever you have DCF value greater than the current share price, that's when you would make buy recommendation. So and you can see it's kind of evenly split here in this table. So basically, if you believe in exit multiple of 19 times at the same WACC, you will not buy this company, right? So you have to believe in 20 times or more at the current WACC, or you need to go with lower WACC. So this kind of green is an easy way to show what are the attractive values. So I'll do the same here, Alt OD, new rule, format cells that contain values greater than, and then Greek methodology price format the cell as green. Press OK. So you've got values here. So you see that WACC is much more important than growth rate in perpetuity, right? Because by lowering WACC, you get good values across the board. And just to finish off our kind of valuation discussion, so we talked about different aspects of DCF. How do we interpret the results? How do we sensitize them? Let me quickly show you comparable company trading methodology. For that, we need to go to FactSet. Okay, so I've logged into FactSet, and what I did here, I typed in a competitor's name under companies, and then I went to comps, and I've added a couple comps here. I've added Home Depot, but basically it gives me this nice comparable company trading table. And what we'll need in this table is this last column showing very typical trading multiple of enterprise value to EBITDA. So you can see Home Depot, the company I'm analyzing, trading at roughly 17 times EBITDA. And then Lowe's is trading at 12, and Target is trading at 11. So it's kind of rule of thumb in investment banking that if a company trades at a lower multiple, then it's a cheaper company, so it's valued less than a company that's trading at a higher multiple. So let's kind of turn that statement on its head and see how we could use comparable company multiples to imply the share price. Basically, the idea here would be to say, if Home Depot traded instead of 16 times at 11 or 12 times, like its competitors do, then what would its share price be? And I can tell it will be less. So basically, if Home Depot traded as competitors, you would actually not buy it. So it's overvalued relative to its competition. So what I'd like to illustrate in Excel, kind of bring the numbers to the same basis as DCF and kind of continue this analysis here and see what share price is implied by competitor company trading. So I'll type Lowe's and target, and then I create some headings here. So we'll start with EV to EBITDA. EV stands for enterprise value. EBITDA stands for earnings before taxes, depreciation, and amortization. I'll move right to text so it's kind of shows appropriately. And then my next column will be implied EV for Home Depot. And then what we will do from there on, we'll back into share price from there on. So we'll kind of go in reverse order from, like actually in a similar order as we just went through in DCF calculation, right? So we'll go from enterprise value to share price. So we'll take minus net debt, and then we'll get equity value. We'll take number of shares. Actually, I'll just keep that here in this table, and I'll go right into share price. And then recommendation, you know. So we'll kind of replicate what we just did. So that's our quick comparable company trading analysis. And again, what's important here, what we start with, I'll copy format here for multiples. So Lowe's, what did they trade at again? So 12 times for Lowe's and 11 times for Target. I'll just use round multiples here. So implied enterprise value. So basically, if Home Depot traded 12 times, its enterprise value would be 12 times. And it's important to pick the right EBITDA. You'd kind of have to go back and see what EBITDA was used for these competitors. I assume it's historical EBITDA, so I will take the last historical number. It could be the last 12 months, which we don't technically have, or it could be a forecasted EBITDA. I mean, you'd have to kind of double check that. But let me put in historical number for now. So I just multiplied the multiple by EBITDA. And if anything, it'll be, well, it is conservative, I guess, yeah. So I'll freeze EBITDA, copy it down, and then subtract net debt. And then when I add up net debt and enterprise value, I get equity value. And then I'll divide equity value by the shares outstanding. I'll freeze that. I get 168 and 152 compared to the current share price of 269. So relative to competitors, Home Depot is overvalued. And if you believed that Home Depot should be trading similar to competitors on EV to EBITDA multiple, then you would sell the stock. So let's just put it in a formula. So recommendation, we'll say if this implied value by competitive trading analysis, if it is more than the current share price, 269, I'll freeze that, then you would buy it. But otherwise you would sell it. You will sell it. All right, so that concludes financial modeling discussion. We've kind of added on DCF and comparable company trading analysis to it. So these are nice kind of practical applications of financial model. And then in the next class, we'll use this very model and we'll modify it for leveraged buyout situation. See you soon.